I've mentioned many times, the whole crypto market is driven by two things: network adoption, which is the long-term trend, and then in the middle is the liquidity cycle. The liquidity cycle hit a bottom in June, and we started seeing the forward-looking indicators come up. And we've seen already the central bank balance sheet was led by China, Japan, and then the US. That liquidity cycle is in full flow now. So that should continue all the way through till 2025. And that's why we started Crypto Spring. It happens every time we get to this point. We so forward looking, the liquidity cycle should continue. And the banking situation is one of the examples of how the liquidity cycle comes in. The Chinese continue with M2 growth, the use of the central bank balance sheet. The Japanese have obviously been using yield curve control. So for me, we're in the right cycle now, and this should continue to play out. Now, within those, you get plenty of volatility. Usually you get 35% pullbacks are pretty common. Is this a 35% pullback we're in the middle of, or a shorter one? Don't know, don't really care. I did all of my allocation. I hadn't sold anything ever. I just bought more in June, October, and January, and just used that opportunity into the big sell-offs, and that's it.
Bitcoin is seeing a logical and healthy pullback, say commentators, with $25,000 now a key BTC price line in the sand. Bitcoin barely held $27,000 on April 22nd as another round of losses left bulls with little firepower. Hello and welcome to Money Talks. In today's video, Raoul shares with us his outlook on the future of crypto markets and his view on regulations for Bitcoin.
So the tightening, it's not about interest rates, it's about liquidity. So the change in interest rates is a part of the liquidity cycle, but the central bank balance sheet is the predominant driver plus M2. There is about a 90% correlation between the price of crypto assets and a global liquidity index that we use, which is a function of the G5 central bank balance sheets plus the Fed balance sheet. Look at the G5 central bank balance sheets plus their M2. So look at the central bank balance sheet there with the Fed, and you saw that little spike, which was the injection of liquidity into the banking system, and all assets rose with that. And so, yeah, the interest rate rises are a red herring at this point. It so happened that Bitcoin was launched exactly at the time the global interest rates went to zero. Everybody reset their entire interest rate and their entire debt burden at the same time. Everybody around the world. So every central bank, every country, every corporation, everybody reset rates at zero. It's created, and most of that debt is between 3 and 5 year debt. And what you've got is this 3.5 year cycle to 4 year cycle. And it's a global phenomena, and it was driven by interest rates being zero in 2009. And that is the Bitcoin halving cycle, because Bitcoin was launched exactly at that point as well. So the liquidity cycle is the predominant driver. Now, doesn't mean it's wrong to follow the Bitcoin halving cycle, because it happens to be the macro cycle as well. And that's all well and good. And if people understand it in those terms, that's fine. But it is actually the liquidity cycle that is global, and it is a complete structural change to the world that happened after 2008. That if you look at the ISM cycle, so the Institute of Supply Managers survey, it is exactly 3.5 year cycles. And we've never had this before, and it's just driven by the debt refi cycle globally.
In contrast to United States equities, which managed to seal modest gains on April 22nd, Bitcoin continued to suffer as analysts warned of a return toward $25,000. With that, BTC USD was down 10% for the week and 4% in April overall, according to data from monitoring resource CoinGlass, amid a dramatic turnaround in fortune versus much of Q1.
Meltem's video earlier is everything you need to know. There is a risk curve, and people will move on the risk curve depending where you are. So when you're in Crypto Spring and there's uncertainty, you go to the safest, most secure, most known asset and the most liquid, which is Bitcoin. Then you tend to then spill out, and you see then Ethereum start to catch up. But as people become more confident in the cycle itself, you see it spread further out of the curve, and you're starting to see that already. I mean, Solana had a huge run this year. There's a few things that have had a huge run. It's not consistent yet. So it's very common that the Bitcoin dominance falls. It's the same in the credit market. People buy treasuries first, then they buy corporate credit, then they buy junk bonds, then they all blow up and we start all over again. I mean, it's a standard way that we operate. So it's very common. So crypto's no different than financial markets. I did a lot of work on Metcalfe's law, network effects, and how to model it. And I found that really most of it is explained by two factors only. One is number of active addresses, and the other is the value exchanged on chain. So those two pretty much match price. So what Dan's saying is right, and what Melton's saying is right, is you need activity on chain. It's not just the active addresses. As long as they're doing stuff, the value of the network increases over time. But there needs to be activity. So, it depends what demand there is for the Bitcoin blockchain. It's as simple as that. Right now, if you look at the number of different applications being built on Ethereum, you generally think that the network will likely grow faster over time than Bitcoin. But that can change. We've got ordinals. We've got other use cases for Bitcoin. We could see global central banks or sovereign wealth actors involved in Bitcoin. So it depends. I think likely Bitcoin dominance falls over time because of the lower number of use cases. But it's not something I worry about all day or think about.
For popular trader Credible Crypto, however, there was still every reason to hope that the long-term uptrend remained intact. If your macro thesis on Bitcoin has changed because of a $2,000 pullback after a $10,000 plus vertical rally from 19K to 30K, plus you're doing it wrong, he insisted in part of his latest Twitter commentary.
What you've done with ETH is you've created a money market curve of what is, a reasonably complete digital economy. And the money market curve now allows people to stake at will, reduce some risk in the system. There's no real reason why people at the early stage of a cycle are going to take their ETH out. They will do at some point and put it into other stuff as they go out the risk curve or go down the risk curve and go back to Bitcoin. But I think it's a very sensible thing. And actually, it's setting up for something I think a little more complex that I've got my eye on, is we've got an issue that staking is going to rise in ETH because it's got a good yield. It's reasonably understandable, so it gives us some sort of risk-free rate within the space. The issue is you've also got the ETH burning, and you end up with a very limited supply of ETH in a bull market. Now, I understand that that as the cost of compute goes up, what you end up with is less burning over time. But there is an issue that you could end up with a very squeezy market, and it could be a problem for ETH, actually.
You say the ETH staking reward is high, but right now you can get 4%. As Dan was saying, you can get 4% for just putting your money into a government T-bill.
Yeah, but you're choosing, it's a currency, right? So you are investing in a currency. You've made the choice, like you live in South Africa, you will try and hold non-South African currency. You get different yields, right? So if you've chosen to live in Web3 world, okay, here you've got an asset that has a high quality asset that has a decent enough yield. It compares to traditional yields. We're not asking it to have more because it's got a much different risk reward profile than the US dollar or US treasuries.
Yes.
But it's a way, if you want to park capital in the space passively and still participate, you get a yield, much like if you went to US dollars, you might put it into the US bond market and try and get a yield from that. There's no difference. I generally hold a basket out the risk curve, and it's kind of very weighted towards ETH, have a bit of Bitcoin, but then I will look for what I think gets network effects, and I think Solana has some potential of provable network effects. As Dan said, it's still kind of at the VC stage, but I see a lot of activity on chain. I see a lot of developer activity. I see a lot of wallet addresses, etc. So, I hold stuff, including Doge, because, Doge is a really interesting one to me. The reason I've done it, and I've held it for ages, and it's a tiny position, is it has, if you think of the Metcalfe's law model, it has a lot of active addresses. What it doesn't have is any use case. Now, all it requires is one
use case,
which is Elon. If Elon uses it for Twitter, you have network effects very fast. So I'm like, I'll take that option. Why not? And, because as Melton points out, a meme is a use case as well. Culture is a use case.
So, is it a good time to invest in Bitcoin? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.